They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built a billion-dollar mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to the DO Show, where I teach the lessons life taught me the hard way. Before you freak out about 50-year mortgages or think portable mortgages are the magic solution to affordability, take a deep breath. Most of what you're hearing online is incomplete or flat out wrong. The U.S. mortgage system is the most admired in the world because of how our loans are funded, packaged, and sold. And that's exactly why ideas like portability and ultra long-term mortgages don't work the way people assume. Today I'm going to explain in plain English what's real, what's hype, and what every realtor, loan officer, and future homebuyer must understand. I'm Dustin Owen, and this is the DO Show. So let's talk about what you're hearing. Ever since Director Bill Pulte started tweeting about 50-year mortgages and portable mortgages, the headlines have been wild. And my phone has been blowing up. Loan officers want answers, realtors want answers, home buyers want answers. Everybody wants to know, is the 50-year mortgage coming? Is portability finally happening? Should I wait to buy a home? These ideas sound great on paper until you understand how our mortgage system actually works. Because the conversation out there is missing most of the context. So today you're getting the full picture. To understand why 50-year mortgages and portable mortgages are not likely coming anytime soon, you have to understand what makes the U.S. mortgage system different from the rest of the world. In the United States, our government, through Fannie Mae and Freddie Mac, provides something called a liquidity facility to banks, credit unions, and lenders. That liquidity facility is the secret sauce. When lenders make 15 or 20 or 30-year fixed rate mortgages, Fannie Mae and Freddie Mac are going to buy those loans as long as those banks and credit unions met the Fannie and Freddie guidelines. Then Fannie and Freddie package those loans into mortgage-backed securities and sell them as bonds to investors like hedge funds, pension funds, and life insurance companies. That process creates liquidity, and that liquidity is why the U.S. is able to offer a true 30-year fixed rate mortgage. Countries like Canada, the UK, they don't offer 30-year fixed mortgages. The rest of the world sees our system and says, America has got it figured out. Everything we talk about today has to be viewed through this lens because our system is not built like theirs. And guess what? Theirs isn't built like ours. Portable mortgages exist in Canada. They exist in the UK. They work because most of their mortgages are ARMs, aka adjustable rate mortgages. And those mortgages stay on the bank's balance sheet. They are not 30-year fixed mortgages. That means they're not securitized and they're not sold off as bonds. They are portfolio loans. Understand this about portability. Portability allows you to take your current mortgage and move it to your next home purchase as long as you sell your current house. It allows you to take your mortgage with you. But what no one wants to talk about is you almost always need a second mortgage because most people upgrade when they move. That's going to create a blended interest rate. You have a rate on the loan that you're porting over added in to the rate of this new second mortgage that you're going to need to apply for and qualify for. And typically the rate on that particular second mortgage is going to be substantially higher than the rate on the loan that you're porting over, giving you a blended rate. Trust me when I tell you, it's messy and it's complicated. And it only works because their entire mortgage system is built around adjustable loans. So it sounds great in theory, but in the US, we run on 30-year fixed mortgages. And that happens because of securitization. And securitization is what kills portability. Your mortgage isn't held by your lender. You have to understand this. Your mortgage is sold, it's packaged, it's pooled, and it's turned into a bond. And investors buy those bonds, and those investors want a predictable fixed payment stream for 30 years. If you want to port your mortgage, you are asking that investor to swap out the collateral for a different home in the middle of a 30-year agreement. That means unsecuritizing the loan, reworking the entire bond, and replacing it. No one's going to sign up for that. Portable mortgages in the US would only work on new loans, and those loans would have to be ARMs, more than likely kept on a bank's balance sheet. And rarely do a lot of people actually want a 5, 7, or 10-year adjustable rate mortgage, especially at today's rates. Most people would rather get a 15, 20, or 30-year mortgage at today's rates and then refinance when rates drop in a couple years. So let's put portability to rest and let's get into 50-year mortgages. A 50-year mortgage does one thing. It lowers the monthly payment. That's it. It doesn't actually fix affordability. It doesn't reduce the cost of homeowners insurance. It doesn't reduce the cost of taxes. It doesn't create more inventory. It simply stretches out payments longer. But when you stretch a loan from 30 years to 50 years, what ends up happening is you barely pay any principal in those first 3, 5, or even 7 years. So if home prices end up staying flat for the first 3 to 5 years that you purchased your home, and let's say you're a first-time home buyer only putting 3 or 5% down, you might not have enough equity to sell your home without bringing money to closing. The product is being pitched to first-time home buyers, but they're actually not the ones who would benefit the most, and they are the most at risk. So let's run some numbers. Let's break down what everyone wants to know. What's the payment difference? How much principal is actually being paid down? And better yet, what would happen if I did a 50-year fixed mortgage and I reinvested my payment difference? So let's go ahead and break down some numbers. Let's look at some payments. If you assume a loan amount of $350,000 and an interest rate of 6.25% on a 30-year fixed, your principal and interest is going to be $2,155 per month. On a 50-year mortgage at 6.5% interest, the principal and interest payment would be $1,982. The difference here is $173 per month. In the first 3 years of your 30-year fixed mortgage, about $18,300 in principal is going to be what's paid. Now on a 50-year mortgage, in that same time frame, it's only $4,500. In the first 5 years on a 30-year mortgage, about $32,000 is paid down. On the 50-year, only $7,900 would be paid down. In the first 7 years of a 30-year mortgage, it goes up to $46,000. On a 50-year, it's only going to be $11,000 of principal paid down. So to put it bluntly, you can see where a home buyer, especially a first-time home buyer, could get themselves in a world of hurt by choosing a 50-year fixed mortgage instead of a 30-year fixed mortgage because of how little principal they actually pay down over those first 3, 5, or 7 years. It's almost like they'd be better off doing an interest-only loan, and we all know what happened to home buyers back in 2007 and 2008 when interest-only loans were so popular. Now let's flip it, because I did say a 50-year fixed mortgage would be good for somebody that was super savvy with their investments. So let's assume you invested that $173, that was the payment difference between a 30-year and a 50-year. What could you do if you saved and invested that money every month? Well, if you're investing $173 per month at, let's just say, 8% annual compounded interest. After 7 years, your investment account would be worth about $18,000. After 15 years, it'd be worth about $52,000. And after 30 years, you'd have about $236,000. You can see where a savvy, disciplined consumer could absolutely take advantage of a 50-year mortgage. But that is not who this product is being proposed for. Let me humanize this for you. Let me tell you a real story that explains exactly what's happening today. This is a story about my friends Rob and Jennifer. Rob and Jenny bought their home 10 years ago. They refinanced it into a 3.25% interest rated mortgage. Their family has grown. They now have 4 daughters, including twins. They want a bigger home in a community right down the road, but they are not going to walk away from their 3.25% mortgage. So instead, they're converting half of their garage into another bedroom and staying put. Millions of Americans are in the same situation. A 50-year mortgage is not going to unlock them. Enough about my friends. Let's jump into how this sausage is being made. Let's talk about the thing that most people do not understand. It's, well, how mortgages actually get made. We do not make loans just because they sound good. We make loans that the secondary market is willing to buy. That secondary market is called the bond market. And the bond market does not want 50-year duration bonds or 50-year mortgages. The only way to make them buy it is to raise the interest rate high enough to make it appealing. That eliminates that payment savings and increases demand without increasing supply. We do not have a demand problem in the US. We have a supply problem. We have an insurance costs too much problem. We have the taxes are too high problem. Rates currently here in 2025, rates are in the mid-6s on a 30-year fixed mortgage. A 50-year mortgage is not going to solve affordability issues when all of a sudden a 50-year mortgage may be at 7%. A 50-year mortgage isn't going to create more housing inventory. It's not going to make homeowners insurance become more affordable or for taxes to come down on real estate. Now let's do the same thing for portability. Let's address portable mortgages just, one more time. This is why portable mortgages do not solve anything. Portability works elsewhere because their loans are adjustable and they stay with the bank. In the US, we securitize everything. Portable mortgages here would only apply to new ARM loans held in a portfolio of a bank or credit union. That does not help the millions of people locked into 2.5% or 3.5% mortgages. The ones they got back in 2020 and 2021, the COVID years. Those loans are vintage. They are permanent. They are not portable. And portable mortgages going forward will not help someone who wants to move in the next 2 to 3 years when rates will likely be the same or even better than they are today. Y'all, we all need to understand this topic is so new that it was not even discussed in 2025 at the Mortgage National Advocacy Conference. But I promise you, when I travel to Washington, D.C. in the spring of 2026, these two topics will 100% be on the agenda when we meet with senators and representatives. Here's the one thing I want every realtor, every loan officer, and every home buyer to walk away with. Mortgages are not one size fits all. Every consumer has different goals, different finances, different timelines, and different risk tolerances. The job is not to chase hype. The job is not to chase headlines. The job is to be informed. Make decisions based on reality, not Twitter. If this episode helped you, please like it, drop a comment, and share it with someone who needs clarity right now. We all win when we are informed. We all win when we understand the system. We all win when we make decisions based on facts, not fear. Thank you for tuning into the DO Show, where we teach the things they do not teach in school.